Hello and welcome to our attendees for this webinar. We'll just wait for a minute or so for a couple more people to join us, and then we'll make a start on the webinar. So hello and welcome to today's webinar from wherever you are around Australia or overseas, as some of our participants are. My name is Charles Moore and I'm the South Australian representative for Ostmine. Now, for those of you who may not know us, and given our wide audience today, Ostmine is a national industry association representing the Australian met sector. And we have over 730 members nationally, as well as linkages with a number of international companies, such as our participants today, CRU. We exist in Australia to help the met sector grow. And as many of you are aware, the met sector, in terms of employment and activity, is almost the same size as the mines themselves in Australia. So we're a major partner. And today, we have a terrific presentation coming from our CRU partner, Copper Markets in Transition, Geopolitics, Processing and Supply Chains. But before we head into the presentation, I'd like to acknowledge the traditional owners of the lands on which we meet and pay my respects to elders past, present and emerging. In my case, I'm in Kaurna land in South Australia. So this webinar is an introduction and taste tester for our upcoming National Copper to the World Conference to be held in Adelaide on 2nd and 3rd of September 2026. This is the 11th year of the conference, which has become a flagship for all things copper across the copper value chain in Australia. So why copper? Well, it's one of the most important metals for our modern living, and it's underpinning our national and international decarbonisation efforts. And why Adelaide? Well, it's home to the majority of Australia's copper mineral resources. And so the Copper to the World Conference will bring together the industry leaders, governments, researchers, innovators and investors shaping the future of the industry. We're anticipating nearly 600 attendees, with over 40 exhibitors and 70 speakers from across that METS, research, policy and mining sectors. And naturally, we would encourage any of you who are on the line to attend, whether in Australia or overseas. As you can see on the slide there, we've got a range of major companies participating. We'll have more information on how to become part of that conference later in the session. But today, we have one of our original and continuing Copper to the World partners, CRU, to give insights on the copper sector and some of the competitive influences on it from an international perspective. And while the presentation is running, we encourage you to post some questions in the Q&A section of the Zoom chat, as we'll have about 10 minutes to discuss these at the end. You'll see that Q&A at the bottom of your Zoom session. Our two speakers today have in-depth knowledge and insights into the mining sector, with particular emphasis on copper, and some would say its competitor, aluminium. So I'd like to welcome Piers Montgomery, as you can see on the screen there, who's the Principal Copper Long-Term Service of CRU, and Tiantian Zhang, the Lead for Casthouse Market Service at CRU. And I'll leave you, our audience, in these two capable people's hands for the next 35 minutes. Over to you, Piers and Tiantian.
Great. Thank you very much, Charles. And thank you to the team at Osmine for giving us the chance to speak to you today about the peculiarities, some might even say the machinations of the copper market at present. And while much of the commentary rightly focuses on record high prices and the trite but right supply shortage narrative into the medium term, today I'm going to focus on some profound shifts taking place in the structure of the supply chain that has been the result of government policy and ructions in the geopolitical system that is redefining the economics of the supply chain. Thank you very much. So our first slide, we're going to look at, say, US tariffs. I mean, very topical. It's on all of the newsletters I got even this morning. We're talking about the will they, won't they introduce the tariffs on refined copper following the imposition of a 50% tariff on semis products last year. So the US Secretary of State Howard Lutnick had been expected to finalize a report on whether these tariffs should be extended to refined metal. And that was due at the end of June, but we've heard nothing. And the market is, well, I thought it was divided pretty evenly on whether these were going to happen. But looking at the latest bill of lading data, that indicates July was probably a record month for shipments of metal into the US, it seems that maybe a few more people have made up their mind. But as you can see there, the chart on the left, there's a huge amount of copper that has accumulated both on exchange and off exchange, the slightly lighter, sorry, the darker color there, the darker red. So that most of the refined metal in the world now is in North America, which is a little bit of a peculiarity given that the US isn't a particularly large consumer anymore of metal. But of course, this is all part of the arbitrage play. You know, copper is now a very mature, deep, and liquid market. And while we wrote earlier this year about the growing influence of China in determining commodity market pricing, something that's actually been underway ever since really the Shanghai Futures Exchange opened their night session back in 2013 that allowed traders to arbitrage prices to the London Metal Exchange. But equally, I mean, they have that opportunity first thing in the morning to the North American Exchange as well, COMEX. And ever since this potential imposition of tariffs in the US, not surprisingly, COMEX prices have traded at quite a significant premium to those both on Sheffy and in London. So that averaged about 350 tons in July. So, of course, this incentivizes traders to move metal into North America, where really it's become trapped. And even I think, even if they were to introduce, or sorry, weren't to introduce the tariffs, there are very good reasons, as we found out back in the GFC, why metal can stay where it is for long periods of time through repurchase financing agreements with banks and so on and so forth. So, really, what has happened is that we've taken a market that would have been in a pretty hefty surplus of something around sort of 600,000 tons for both 2025 and 2026 and created one that's actually very balanced with all of that metal that's accumulated in North America. So just looking at the chart on the right hand side, it poses an interesting question, I think, in how we view the copper market going forward. Because when we look at prices in terms of weeks of consumption, you can see there's a very close relationship there. High back in looking at sort of the early 2000s, you've got very good coverage, sort of 5, 6 weeks, and of course prices are low. You get up into those more recent era, and you can see from 2020 to 25 the light blue boxes. And when you're down at less than 1 week of consumption, of course, that's when there's a scarcity premium that becomes part of the pricing of metal. And from prices where we are today, we're well above that to the top of the y-axis there. But how do you view these stocks now? And that really is quite an interesting determinant of where you think prices should be. Because if you look at over 1.5 million tons of copper metal, just simply as a headline number, you're very well covered in a market of about, say, sort of 28 million tons of demand. So call it 3 weeks of consumption. But then if you take out that metal in North America and bring it back, to what's in the rest of the world, you're down at less than 1 week of consumption. So, very, very polarizing in terms of how you view the market and therefore expectations of prices. So that's probably the first one, looking at sort of government policy. If Caitlin, if you wouldn't mind moving to the next slide. So the other major event that we've seen in the last 18 months, of course, has been the events in the Middle East. But even before those started, we'd already started to see a rise in prices for key raw materials, not least of which was sulfur, which saw a more than 200% increase last year. And as a result of the closing of the Straits of Hormuz in February, and then following that, an export ban from China, the one of the world's major suppliers of refined fuels from the market, which has amplified shortages and price pressures to emerging markets that have become dependent on imports of sulfur and sulfuric acid, namely the Indonesian nickel industry, for example. You've had this very large increase in prices. Similarly, fuel has also risen, as you would expect, given the geographical locale of the conflict. But these sulfur prices and sulfuric acid prices, I'm going to say, we're going to look in a minute at how they affect the midstream, the smelting operations. But at least the mine level, they've really only impacted what would be a reasonably small proportion of mines. Because you only really need sulfuric acid for those solvent extraction electrowinning operations. So the acid that you use before the solvent extraction process, you're leaching the ore at the front of that. So that's those mines account for their outsized exposure to Central and South America, where SXEW operations account for about 15% of overall production, compared to a global average of only 6%. So yes, it certainly is having an impact, but it's more, I would say, at the periphery for the mines. So just looking at the chart on the right-hand side, and that really sort of brings it home, is yes, we did see a little bit of an uptick in these costs. So this is the average costs of mining in the stacked columns. And then you can see the price line for copper above that and our expectations moving forward to the end of this decade. So in 2026, yes, we saw a little bit of an increase. And in 2027, we're expecting to see a little bit of a reversal of that, as hopefully there's an end to the conflict, and sulfur and sulfuric acid prices, as well as fuel prices, start to fall back to more normal or usual levels. But I think that what this really shows is that, as we have seen what look to be quite dramatic cost increases on the left-hand chart, but when you compare them to the price increases and what you could determine is excess margin that miners are able to extract now, as a result of these rising prices that are expected to stay strong into the end of the decade. It really is. I wouldn't say it's irrelevant, because of course costs are in the mining industry. This is the average. This is not, and this is not the truth for everyone. But it really does show that we are in exceptional times, and we should expect. If ever there was a time to build mines, this is certainly it. So to the next slide, please, Caitlin. So if the rise in acid and sulfur prices hasn't been that consequential at the mine level, it's certainly it's been transformative for smelters. For every ton of copper concentrate with a sulfur grade of around 30% produces 2 to 3 tons of sulfuric acid at the smelter. And for the last sort of 12, 18 months, we've actually seen the majority revenue stream for these smelters, treatment and refining charges that they're paid by the miners, because of a mismatch between weak mine supply and burgeoning smelter capacity, those headline terms have actually moved negative, which is a very perverse situation to think that a miner is being paid above and beyond the value of the copper in the concentrate for the smelter for the privilege of transforming it into refined metal. So, of course, that just simply indicates the sheer level of competition for these concentrates. And it's really only been the increase in acid prices that has kept a lot of these smelting names afloat. So, for example, we talk about, let's say, domestic acid prices at around 1,860 RMB in China. And the increase that we've seen, that's more than double what we saw in December 2025. So 800 RMB increase in acid prices since the start of the year equates to a theoretical treatment and refining charge of $69 per ton. So to put that into context, that was around where we see the incentive price for building new smelters, but the current market is actually at around minus 100. So without the offset of this increase in sulfuric acid prices and to some degree as well precious metals, then the smelting industry would really be in a very different position. It would we'd see a lot more capacity utilization, a lot lower capacity utilization generally, and a lot more possibly permanent shutdowns. But certainly on the right-hand chart, you can see that there's a lot of maintenance that has been conducted as well this year. That smelter decrease number is a lot higher than it would usually be as a result, as say, of these headline treatment refining charges. Because copper smelters really, in all but name, are acid plants at this moment. They're not really generating anything from their traditional revenue stream. So this leverage to acid prices as well at a regional level in China means that that's created winners and losers. Of course, you use the acid for fertilizer. And so in agricultural regions where prices are higher, that's conferred quite a strong advantage in some of the provinces like Anhui, Guangxi, Shandong, Fujian, maybe at the expense of some of the more remote smelters in China as well. So to the next slide, please. Having said that, nonetheless, even if there is competition within China, they are very well placed. The larger smelters that are part of this CSPT, the China Smelter Purchasing Team, which is a collection is probably the nicest way of putting it of groups who negotiate together with the miners for these annual treatment refining charges. The costs of these smelters is much, it gives them a much, confers a very significant advantage over smelting in other regions. For example, Central and South America and Oceania, electricity is the most dominant component across all regions, but actually it's probably labor that, so you can see North America's labor cost, there's nearly 3 times that of China. So, it's some of the add-ons that are in addition to the lower electricity costs that are really drawing this distinction, and maintenance costs as well stand out, especially in Africa, where aging infrastructure and the replacement costs of some of the PPE associated with those smelters means that that's a particularly high cost category on the mother continent. Here in Australia, looking at the lower curve, and I apologize, I haven't marked it, but Mount Isa is the largest downgrade we've seen this year in terms of the smelter cost curve. And a lot of that, of course, is to do with the closure of the associated mine, but also with a reduction in feed from flood hit Ernst Henry, weakening fixed cost absorption. So in other parts of the world, ex-China, say they're at a natural disadvantage. We're seeing much lower utilization rates, less than 60% in Oceania and around the same in the Americas, which is significantly lower than China. So to the next slide, please. And this is really the reason for it, is those treatment refining charges deep in negative territory as a result of there simply not being enough concentrate to feed burgeoning smelting capacity. While in this chart we have a deficit of nearing 900 KT, that's actually, we've adjusted that lower recently as a result of Mitsubishi's decision to say that they're going to stop smelting concentrates at their Onahama plant in Japan from March 2027, which just gives you an indication. Say that's a very long established smelter. Of course, the Japanese have been integral to both to the smelting industry following the closure of their domestic mines for since the 1950s. So very significant changes taking place as a result of this. It's always it's tempting to say once in a generation, but it really does feel like it's a structural shift in the industry that's taking place as a result of this long period of prevailing lower treatment and refining charges. Looking at the chart on the right-hand side, there is the strategic nationalism that is driving the build out of infrastructure in a number of countries. Indonesia, well, that was for reasons of upgrading revenue streams, but India being one of the best examples with the Adani smelter there. But it's also taking place in a number of other countries, and quite significantly, these are all part of the ones that I've shown here in the chart. These are all part of integrated supply chains. So while you might say, okay, a build out of new smelting capacity generally might lower the influence of that China smelter purchasing team that I showed on the chart before, that's not actually going to be the case. They're still going to retain a very prominent, potentially dominant role in the industry. As I say, because this smelting capacity that's coming on is coming on as part of independent supply chains and actually removing concentrates, potentially in the case of, for example, Kamoa-Kakula, removing concentrates from the international market that would otherwise be available. So it could even be strengthening their position when you look at it on that basis. To the next chart, please. Next slide, sorry. And look, this is just to say, okay, we spent most of what I've been talking about focusing on the midstream. This is a flavor of maybe what I'll be speaking a little bit more about at Copper to the World in Adelaide next month, is looking further upstream and where we're going to see the new projects that are coming online to redress that balance in the midstream and deliver the concentrates that the smelting community is so craving. Well, the problem is that the majority of the supply chain, or the majority of the pipeline, sorry, which is our projects that are classified as probable and possible, which is the ones that should really be coming through to meet the challenge of demand. We haven't had a very good track record of delivery from those categories that not only own the majority of the pipeline at present, so the Western majors you can see there and the other Western companies, they've added only 1% to supply between 2007 sorry, and 2025. So that's obviously there's a lot of depletion in from existing mines that hides behind that number as well. But we're going to be relying on what would probably have to be called a paradigm shift, really, in delivery from previous era. What I would say is these charts probably underplay the influence of Chinese SOEs who do have a very good record. You can see there of 13% added or compound averaging growth over that period, because they tend to approach the cycle with a more counter-cyclical investment strategy. They tend to pick up assets at the downturn in the Western business cycle, something that was very evident, say, when CMOC purchased Tenge Fungurume in 2016 and have transformed that from a site that was producing only 160 KT of copper to what would be, by the end of the decade, it's going to be something around 800 KT. So, that's certainly something to watch out for. So I think I'll probably wrap it up there and probably at time. But to say, China's increasing participation upstream combined with the increase in negotiating power in the midstream through the CSPT is creating, quite a significant new order in the copper supply chain. And as new smelter entrants to the market are finding out, it's very difficult to compete with China's smelters to secure concentrates who are well positioned from this perspective to squeeze out their rivals. Having said that, the excess margins at the mine level that are expected to persist until the end of the decade offer the opportunity for Western companies to move forward with the projects that they own and redress this balance, but they need to invest now rather than relying on tariffs to secure strategically necessary copper units. Thank you very much.
Okay. Thank you, Charles, for the introduction and Piers' comprehensive and educating speech. So now let's take a look at the aluminum market side. The biggest news this year on aluminum side is the conflict in the Middle East, which has caused the substantial aluminum supply disruption. We had therefore expected the global market to be in deficit this year. However, we now expect that deficit to be considerably smaller than we forecast in the last quarter. There are three main reasons for the revision. First, the Middle East producers have been more successful than expected in securing raw materials for their operations. As a result, smelters restarts are progressing faster than the market anticipated. Second, the LME price have risen sharply since the disruption began. These higher prices have encouraged the projects in Indonesia to ramp up more quickly. As the purple bars on the chart show, Indonesia projects are adding significant volumes to the market balance. And third, the production in China has continued to edge higher, supported by stronger SHFE prices. So these developments have transformed our outlook. We previously expected the war ex-China to face a deficit in 2027. We now forecast a surplus of 1.3 million tons, the largest since 2004. So this surplus will be heavily concentrated in the second half of next year. And the change is being driven by three major factors. The largest is the restart of EGA smelting capacity, around 1.5 million tons, has already begun returning to production, and we expect the pace of the restart to accelerate. The second is the ramp up of the projects in Indonesia, many of which are backed by Chinese companies. The third is the return of output from other existing capacity. This includes the announced restart of 75,000 ton capacity from Hydro and Max 7 from the fourth quarter of this year. So this major change in the balance raises some important questions. First, because of surplus of the size is unlikely to be sustainable, which producers are most likely to cut output first. Second, how will these LME prices respond, and what will that mean for the industry? And third, with the supply surplus becoming inevitable, what will drive aluminum consumption over the next 5 years? So next slide, please. We expect a large and persistent surplus in 2027 to put significant downward pressure on LME prices, and likely to fall further in 2028 as inventory levels recover from their current very low levels in the century. As a result, the exceptional profitability that smelters currently enjoy will begin to erode, and high-cost producers will become loss-making. Our current forecast is the 3-month LME price to average at $22.40 per ton in 2028, And that level, production cuts are likely to become unavoidable. We expect prices to trigger around 150,000 tons per year of curtailments in Europe and 350,000 tons per year in Australia. Even with these closures, we believe deeper cuts will be required in 2029, and prices will need to weaken further to trigger them. And in our base case, the decline in real prices become less severe in 2030. So we expect a further 250,000 tons per year of cuts to be required. But rising production costs should allow nominal prices to recover slightly in 2030. Next slide, please. As I mentioned earlier, we expect aluminum price to begin falling from their second quarter peak and to remain under pressure over the following few years because of persistent surpluses. Our base case makes three key assumptions. First is the restart of EJ's smelter accelerates and is completed in the second quarter of 2026. Demand growth strengthens in world ex-China, and trade flows through the Strait of Hormuz gradually return to normal. And in our downside price scenario, investors increasingly short the market in anticipation of future surpluses. At the same time, Chinese supply remains elevated and continues to exceed our expectations, while demand recovers more slowly than our base case scenario. In our upside price scenario, production recovery at Gulf smelters experience setbacks. Another important upside factor is aluminum's improving price competitiveness relative to copper. If copper prices continue to rise, substitution could provide additional support for aluminum demand from late 2027 and onward. As the chart on the left shows, aluminum has significantly underperformed copper since ceasefire began. The supply concerns that had previously supported aluminum prices have started to reverse. Looking ahead, we expect this divergence to continue. The surge in aluminum supply could push prices toward marginal production costs, which remain almost $1,000 per ton below current prices. The resulting shift in the aluminum to copper price ratio should support aluminum demand during the later years of our 5-year forecast. Next slide, please. So let me now turn to the demand side, including the potential for aluminum to substitute for copper. We expect global aluminum consumption growth to bottom out at 1.6% year-on-year this year, the weakest rate since the COVID period. China is expected to slightly outperform the world ex-China, supported by the strong export momentum following the Middle East supply disruptions. In the world ex-China, the main weakness comes from the Middle East because of the continuing conflict. North American demand is also stagnating amid inflation, tariffs, and high energy costs. By contrast, we continue to see strong growth in India and Southeast Asia, supported by urbanization and infrastructure investments. In our base case, consumption growth in the world ex-China begins to outperform China from 2027. We expect a broader global demand recovery with growth reaching 3.4% year-on-year next year. Let us look at the outlook in more detail by sectors. On the chart on the left, we divide consumption into two categories. Traditional sectors are shown in gray. Emerging sectors are showing in color and include data centers, which are expanding rapidly because of the AI investment boom, battery energy storage system, or we call it BESS, electric vehicles or EVs, and other applications such as robotics and the low altitude economy. As you can see, the 5-year CAGR for traditional market is almost flat. Most incremental growth comes from EVs and BEVs. Data centers are growing rapidly, but weight is less important because these facilities are stationary. So steel, therefore, remains the main material used for the structure frames. BESS is different. These systems are often installed in containers that must be transported by road and comply with weight restrictions. That creates a stronger incentive to use lightweight aluminum. Next slide, please. Thank you. As mentioned earlier, on tailwind arising from lower LME prices is potential for aluminum to replace copper in selected applications. So total aluminum content in an EV can reach almost 300 kilograms per vehicle. However, the figures showing here refer only to applications in which aluminum can potentially substitute for copper. Among the emerging sectors, EVs offers the greatest substitution opportunity. Taking battery electrical vehicles, BEV, as an example, we estimate the aluminum reuse in wiring and battery-related applications will rise from 50 kilograms per vehicle in 2025 to 56 over the forecast period. This is an increase of 6 kilograms per vehicle and could displace close to 20 kilograms of copper per vehicle. High voltage wiring is expected to experience the fastest rate of substitution, with aluminum's share most doubling over 5 years. However, copper is likely to remain dominant in winding wire, where the scope for aluminum substitution is limited. And several major automakers, including Ferrari and BMW, following Tesla and leading Chinese EV manufacturers, have publicly announced moves from copper to low-cost aluminum selected applications. Price is not the only motivation. Aluminum can provide comparable performance in suitable applications while reducing total wiring weight by as much as 20%. So the substitution has occurred in waves over the past 2 decades, but the recent surge in copper prices has strengthened the economic case for switching. We expect EV penetration in auto market to increase strongly, with significant more EVs being produced over the coming years. As a result, EVs should become one of the largest sources of incremental aluminum demand. Next slide, please. Data centers also offer substitution opportunities, although copper is likely to remain the larger of the 2 metals in overall conductor demand. We estimate the aluminum intensity could increase by around 1,000 tons for every gigawatt of installed data center. This could reduce copper consumption by around 2,700 tons per gigawatt. Over the longer term, aluminum should gain some market share because of its lower cost and potentially greater supply availability. However, copper is likely to retain the majority share because of its superior conductivity, temperature resistance, corrosion performance, and mechanical properties. Aluminum conductor also require a larger cross-sectional area to provide the same conductivity, which can be a disadvantage where space is limited. Within data centers, copper is expected to remain dominant in internal telecoms equipment and winding wire as it is in EVs. Power cables offer the clearest opportunity for aluminum substitution. So to conclude, our aluminum outlook has changed significantly in short period of time. Faster restarts in the Middle East, rising Indonesia output, and continued growth in Chinese production have shifted the market from an expected deficit toward a substantial surplus in 2027. And that surplus is likely to put pressure on prices and eventually force high-cost capacity to close. At the same time, lower aluminum prices relative to copper should improve aluminum's competitiveness and support substitution in EV wiring, energy storage systems, and data center power cables. The central question is therefore not simply how large the surplus will become, but how quickly lower prices will stimulate demand and trigger the production cuts required to balance the market. That's all from my side. Thank you.
Well, thank you very much, Piers and Tiantian. I think you've really given us a fantastic presentation on both copper and aluminium. In fact, your insights on the impact of geopolitical decisions on world copper inventories, the rather perverse cost structures for copper smelters, and then the impacts of changes in the aluminium market for copper were really insightful for our audience, I'm absolutely sure. I might add, from a copper conference point of view, it's a bit sobering to hear about the substitution story for our industry sector. However, it's really valuable to know about these trends and to understand completely there's both supply and demand in the market and what's happening. So thank you very much. Just before I continue, we will be having some questions. I've got two open on the question and answer. And in fact, I've got a third one has just appeared as well. So we'll cover those shortly. But I'm also going to give a plug for our Copper of the World conference just quickly before we take the questions. Piers, you did mention that you've got more information at our conference. I think we'll really look forward to having those further insights. So I've now got a couple of questions here. So I'm going to go to them in order. So the first one is in relation to if the market, and I think this is for you, Piers, if the market is in surplus, any views on how much strength of the copper, strength in copper pricing was driven by inventory pull to the US? Was it due to speculations around copper tariffs? So how do you think that might unwind as the tariffs might change down the track? Piers.
Yeah, that's the $14,000 question. It's a really interesting one because I don't know how much copper prices where we got to, in the sort of records that we hit in January, say up at sort of 14,500. There was a lot of speculative frenzy that propelled that to those sort of heights. However, I mean, we've come back from those and we haven't really gone back and say I had a chart there that I was off the top of the axis because it's easy to forget that we only broached $10,000 a ton less than a year ago. So how much of it is due? You'd have to say it's for example, a premium that you pay on top of the copper price for actually delivered metal in locations. Premiums haven't been very high. They've just actually risen in China above to probably the highest in a year, but for a long time they haven't been high, and that's always a good indicator of what the physical market is doing. We can actually also run, sort of principal component analysis to try and isolate various factors in the formation of copper price. And in doing so, we typically look at say the 90th percentile of the cost curve as your base, and then you'd try and solve for then we say that stock component is the scarcity value, and it all depends on what your view of those. What the metal accumulated in the US, if that's available to the market or not, how much of that you think has actually contributed to price formation. So, and then the medium-term narrative, which is really the one that everyone, you get a lot of let's say the more patient, longer-term money that looks at the copper market and says, I want to be part of this story. And that sort of contributes as well. So it's very difficult to isolate all of those. But what I can say is if there was no, let's say there was no tariffs and there was no export protection for that metal in the US, well, it is sitting there and it is potentially coming back to the market. If we talk about US demand being, let's call it 2 million tons a year, you've got 6 months worth of copper just sitting there, excess surplus really to requirements. There is the potential for that to certainly weigh on prices in the international market if it were to be allowed back out. But given that the US administration's goal with these tariffs is to build a domestic copper industry, even if the tariffs don't come in, I'd have to think there'd be some sort of export restrictions that would prevent that.
That's very, very insightful. Thanks, Piers. And as all these aspects, they're sort of quite complicated. There's different elements being linked into it. So thank you for that. I've actually got another question that's come through, which comes back to your chart that had the sort of difference between the costs and then the revenue, the sort of the value of copper, notwithstanding what we heard about aluminium potentially sort of having impact. But the question is, do you expect a wave of new mine project approvals given that persistent excess margins in between costs and revenues, and whether that will in fact bring forward some projects, or are there some other factors at play there?
Yeah, again, it's super interesting in that, I mean, as I think I said, yeah, we've only been above $10,000 a ton for less than a year, and people forget, I think, who aren't as familiar with the mining industry and the sort of time frames involved as we all are, and you're certainly your members in the met sector. Um, these things take time. Studies take time. It's not a case of flipping a switch. You can't just dust off a study from 2023 and, rework some of the numbers and then republish it. Which is sometimes, I think, what, unfortunately is the expectation. So interesting, the studies we have seen coming through, haven't seen a huge uplift in IRRs relative to what you might expect. I think there's obviously we still somewhat conservative in the prices that are being used, which is understandable, but there's also that offsetting cost impact. So the IRRs have not been stellar to the point where it's a lay down Nazare to be able to get the capital you need. But then we are seeing some really interesting financing structures that speak to the strength in the industry. And I think, KGL's Jervois range and the equity path that they're taking is a really good example of, the faith that people have in prices where they are today and those persisting. And that really could be, I say, could potentially be transformative. It's just going to take a bit of time.
Now, thank you for that. That makes sense. And one of the really good parts of this webinar has been highlighting the copper is an international market, and there's production around the world and influencing, and we can then obviously in Australia put our lens across it. But what you've just highlighted is there's some international decisions being made as well. Tiantian, I've got a question here for you on the aluminium supply side. Are Middle East smelters still ramping up to schedule with a re-escalation of the current conflicts? And also a sort of supplementary one is about the Indonesian story that you had in there. Do you think Indonesia has sufficient power to actually achieve those smelter project pipeline? And finally, there's a question which is seems very detailed, is about, do you expect China to breach 45 megaton per annum capacity cap? There's 3 questions there. You happy with those?
Yeah. Yes. Yeah, thanks for the question. So first about the Middle East. Yes, we are still seeing the smelters in the Middle East restarting on schedule. And even though the Strait of Hormuz currently still closed down due to the conflicts, but we still expect the metals are building up and they can still transfer part of the metals out of the Middle East using different ports, using trucks, the different ways that's adding the cost to shipping the metal. But yes, they still can get the raw materials. They can still restart, as they mentioned earlier. And the second, Indonesia, yes, they're also ramping up because right now the LME prices for aluminum is still very high, very attractive for all the producers that can currently running. So there is really no way to stop them to ramp up. And so far, the feedbacks we get from the clients in Indonesia, they are still on the way to ramp up on schedule. That's why in our latest report that's just published in the 2 days yesterday, actually, our base case scenario is Indonesia supply to be added significantly and become the major support, especially next year. And we also heard the producers in Indonesia already offering the volumes on ingot and also downstream products like billet, wire rod, starting from 2027 Q1. So yeah, it sounds like it's very promising. And the third, could you please remind me the question? I kind of forget.
That's fine. You've done very well for the first two. The other one was do you expect China to breach the 45
Oh,
megaton?
the China.
Yeah.
That's a very interesting topic. So in our downside risks for when we forecasting the LM prices, we do forecast the China production could be reaching the limit or even become bit over the cap. So yeah, that is possible. But to be honest, currently the as I mentioned, the export is very strong due to the supply deficit and the disruptions from the Middle East. And second, also the Sheffield price is also very high, and the margin is very attractive for all the producers. So whenever they can run the capacity, they will do it at this moment. So that's why we think the curtailments will happen when the LM price is down to 2200 level. But right now we think that the China was still pushing and producing at the edge. And the inventory level right now in China is also very high. If you look at the data, that's almost 1 million ton on the inventory. So we believe that will continue in short term. Yes.
Well, thank you very much, Tiantian, for that extremely comprehensive reply. And I guess in summary, it also highlights that when the price is right, people will invest in developing projects. So it's watching those supply and pricing. So that's the last of our questions. We're getting close to time. So we also have seen a little pop-up will have come up on your screen about interested in learning more. Naturally, CRU as our sort of partner in this are also interested in helping companies understand more about the markets, and they're happy to help with their expertise. So feel free to answer the poll, and that will be of assistance for them and for yourselves. So, and as you can see on the slide in front of you, there is a copy of the slides available. So scanning that QR code, and we've had it up for quite a while now, and do a short survey just to see how you could understand who's interested in the information and from where we can go from there. So it's been a fantastic and insightful webinar. I just want to, before we do formally close, and also before I thank our presenters, I also want to just to show you how you can join us at the Copper to the World conference. So the slide that's there now has a QR code where you can register. As you can see Piers, and you can actually meet him in person in Adelaide. And the QR code takes you to registration and also more details. Actually, if you can leave that slide up there a bit longer, please, Caitlin, that'd be great. So you can then get more information about the structure of the 2 days, which includes business networking. So naturally, while you're attending the conference, we always like to know more and meet the key people. And of course, if you're a member of Ausbind, which many of you are, there is a discount available for you. But also for those of you who are not members and are interested, then feel free to contact the Ausbind team, and we can provide information on the value of a membership with our wonderful National Mets Industry Association. So I'd like to say thanks again to Piers, Montgomery and Tiantian Zheng. In a normal way, I'd say put your hands together. So I will metaphorically put my hands together for those presenters. You've done a fantastic job today, and perfect timing. It's wonderful to be a host where everything goes to time, and your presentations are terrific. So thank you very much for that. I'd also like to say thanks to our attendees from around Australia. We really appreciate it. And for those who are listening on the recordings at a later time, feel free to make contacts with you. So, look, on behalf of the Ausbind team, thank you again. I trust you all have a productive and valuable rest of the day. and reflect on what we've learnt today, and that our copper and aluminium markets are in fact quite intricately intertwined. So thank you very much. Cheers from me and cheers from our team. Thank you.
Thank you. Cheers.
Thanks, Charles.
Bye-bye.
Bye.